Hey everybody, welcome back to the channel. My name is Justin and today I'm doing a review of another YouTuber. This is Jimmy from Learn to Invest. I have high regards for this guy. I think he is one of the good YouTubers in the finance space. In fact, he goes as far as to let people know when he's going to buy a stock and then always waits a couple of days to actually buy it, which I find pretty interesting. So he's going to go through his update on his portfolio. He has a concentrated portfolio, and I'm going to give you guys, my opinion on what his portfolio looks like, and we'll go from there. So let's just get this thing going.
Over to my investment portfolio. So we're going to kick it off with my first position, and that was this position I took a little while back, right in the middle of COVID. That was Disney. And last time I had reported on my portfolio, well, I had announced that my Disney price was just under $100 per share. Since then, I've actually averaged down a bit more, and I've bought some shares when Disney dipped below $100 per share. Last I saw, Disney's trading at about the same price where my current entry price is. So on average, I'm about even with Disney. Okay.
All right, so let's first talk about Disney. I really like Disney a lot. I think under $100 is a good entry point in general. I think Disney, obviously with the theme parks, they got the cruises. Historically, if you look at their margins, I think they've been around 22, 23%, which is just phenomenal. But I think Disney Plus is an X factor to this company. And I think they can actually get margins in the 25 to 30%, potentially down the road. I mean, you look at Netflix, just with their streaming business, they've been able to achieve 20%, which I think is going to be higher in the long term, especially with the ad revenue that they're going to be generating here shortly. Now, with Disney, I think they have some legacy type content that Netflix and other streaming giants just can't provide. I mean, you're talking about like the Marvel series, you're looking at National Geographic, all the Disney movies that they come out with for, decades now. So I like Disney a lot. Around $97 is his average buy price right now, which I think is pretty good, 9% overall in his portfolio. So good position, I personally think. So let's go on.
Okay. After that, I had Intel. Now, Intel I had bought back when there was a big dip. After they ran into issues, they ran into manufacturing issues. And when they ran into those issues, the stock had a huge jump off the cliff. So I jumped in, I bought some shares then. At that time, it was just below $45 a share. Since then, I've continued to average down in that stock, bring it to just under $38 a share. So I went from about 44 to about 38. Now, I just want to clarify with everybody that I'm averaging down in stocks that look like over the long run, they could be a good investment. They seem to be trading at a value now. And because of that, well, this is a stock that I want to hold. I'm happy to hold for 5 or 10 years. Intel's one of those companies. Disney's one of those companies that I'm sort of borrowing the Warren Buffett method of what if the stock market were to close for the next 5 years, next 10 years? Would you be happy holding these companies? Both of these companies, I'd be more than happy if I couldn't get out of the position or if they didn't trade at all.
All right, so let's stop there. So we'll start with Intel. And I just never really totally understood Intel myself. Intel is a chip making company, one of the biggest chip processors in the entire world. But AMD has really been eating their lunch over the last couple of years. Intel, from everything I've read, has superior chips to AMD, but AMD, even though they offer cheaper, maybe not as high quality of chips as Intel, their customers don't necessarily care about that. They still get what they need from the AMD chips. And I just don't know how Intel is going to keep AMD from eating into their market share. Now, Intel is trying to make foundries and doing other things, but that's going to cost a lot of capital. There's a lot of risk involved with Intel, and with Jimmy first getting in at $43. I've always felt that it's kind of been in the $40 to $50 range as far as the intrinsic value. When I'm looking at companies, I try to get intrinsic value and try to get it at a margin of safety or from 25% all the way down to 50%, depending on the type of company. Intel is just one of those. I think it actually a recent video where I said a buy price is at $25, which it's at now. But it's just one of those that I've never really actually bought into, because I just think even right now there's better opportunities out there. But I do like what Jimmy said about dollar cost averaging down when you really like a particular company, a stock that has really good value, that is cheaper than when you first bought it, and the story hasn't changed. That's the other factor. So Intel's a pass for me right now, but obviously Jimmy does like that company.
So the idea here is buying businesses that I think can do well over the long run. Now, I've also done a video on each of the companies that are in my portfolio. I have this self-imposed rule that I'll do a video. I'll only buy a stock after I do a video. So I'll let you guys know, and then I'll wait a couple of days after I do the video before I jump in and buy any stocks, any new position. So if you're curious why I bought any of these stocks, I try to explain it fairly thoroughly in each of the videos that I did previously. Okay, so this company that I bought after I bought Intel was more of a defensive play, and that's Lockheed Martin. Now, Lockheed Martin, at the time, I had paid about $336 per share and represented, at the time, it was about a third of my portfolio. Now it's about 10% of my portfolio. That one I haven't added any to because Lockheed Martin is way up. At the time, it looked like it was significantly undervalued. Right now, it's about fairly valued last I checked. So it's one of those that I haven't added to my position. I'm only adding to my position because the stock market's been down so much, and if I can get stocks that I like at higher prices, well, why wouldn't I want to buy more as the price declines?
So, all right, Lockheed Martin, largest government contractor in the entire world. I love Lockheed. In fact, the company I work for is a government contractor and is a big competitor to Lockheed. But I have a ton of respect for Lockheed. I think Lockheed Martin is one of those companies you could literally buy and just forget about it for the next 50 years, and it will probably beat the market. I just think so highly of Lockheed overall. And I think that $336 price is really good. Last time I looked, I felt that Lockheed's intrinsic value is around $440, which is pretty close to right now. So I would agree with Jimmy. I think he's going to say here in a second that he believes that it's fairly valued right now, which I do agree with. But I do like having that defensive part of your portfolio, especially going into a recession. I think Lockheed is going to do pretty well. Even with the higher costs, a lot of times the government will actually pick up those costs for you, especially if it's a cost type project. FFP projects might be a little different, but I think Lockheed Martin should do very, very well in its portfolio for a very long time, and also a very good dividend payer.
As long as assuming the fundamentals have stayed the same, and in pretty much all my cases, they have. Okay, moving right along. The next one is a more, controversial company, or call it, a more troublesome company, and that's Alibaba. So Alibaba, previously, I had paid about $122 per share last time I did one of these videos. Again, this stock has been way down, largely due to geopolitical risks of the company and different problems that they've had. But I have averaged down my position some to a bit over $110 per share. Now, this is one of those companies that I think fundamentally the company is good, is strong. I could see a decade from now the company being better. But this one introduces other risks, specifically geopolitical risks, that the company has a role in, but it may not be completely in their control. Intel, as an example, I think if Intel does their job and they can improve the quality of their products and they can improve their manufacturing and prepare themselves for the future, I think they are largely in control of their own destiny. Alibaba could be, but they may not be. So I recognize there is some risk with that one. So I've been hesitant to add too much to the position.
So Jimmy makes some really, really good points here that I want to touch on. So Alibaba, this is a company I've talked about a lot on my channel, and boy, it has been beaten down to a pulp. I mean, I talked about this company 18 months ago. I think when I first started buying it was around $240 a share. But Jimmy makes a really, really good point that, Alibaba is different than the other companies he's talked about because, Intel, for example, if they were to improve their sales, their profits, they're probably going to see an appreciation of their stock price. Alibaba, even though they could have a wonderful fundamentals, there's a lot of other things going into play here with the CCP and all the different risks, potentially the US SEC, delisting the company and a bunch of other things. So there's a different set of risks that comes with Alibaba and other Chinese stocks. And he's making a point that he's not going to be adding onto this because it's not like the other companies where, there's just more risk involved with this particular stock overall. And Alibaba, I think right now, last time I looked, it was around like $75, $80 a share. To each his own. If you're willing to take on the risk, it could be a really good opportunity in the long term, but there is certainly a lot of risk with this company overall.
But for now, it's at about $111 per share. Stock's down below $100 for now, so I'm down like many people are in this stock, and I'm okay with that over the short run. Again, this entire portfolio is intended to be a long-term portfolio. Okay, next up, I bought AT&T. So I bought AT&T, and I had originally bought these shares at about $18, $15 per share. That was pre-spinoff of the Warner Media division of their company. So I had bought the shares, and then they did the spinoff. My spinoff adjusted price was about $18.64. Since then, I have added a little shares, bringing my average price down to a bit under $18 per share. AT&T is one of those companies that I like the Warner Media spinoff. I like that company independently. I'll come back to that in a minute. But I also like AT&T on its own. I think fundamentally, I think that the Warner Media division, the Warner Media part of their business was a drag. I don't think that they managed that well. And I think them independently now is much better, even at their lower dividend that they're currently paying. They dropped their dividend when they did the spinoff. And I'm okay with that. I actually think it's better for the company. So over the long run,
So AT&T, this is one that I've never personally understood. They've always had a ton of debt on their balance sheet. In fact, last time I looked, it was over $200 billion of debt. Now they did spin off Warner Media, which got rid of about $40 to $50 billion of debt off their balance sheet, which should really help. They were never able to really leverage Warner Media to really grow that part of their company. AT&T has always been a really, really good dividend payer, and a lot of these stocks we've talked about have paid really, really good dividends other than, say, like in Alibaba. But for me, AT&T is just never one that I've been completely interested overall.
AT&T is a company that I'm a fan of, and I'm happy to sit there. So far, all these companies, outside of possibly Alibaba, we'll see how that plays out, but outside of that one, I'm happy to sit there and hold these for a long time and not worry too much about it. Okay, next up, we have Activision. Last time I did an update of this stock, of my portfolio, I had announced that I had paid about $63 per share. Shortly after I bought the stock, Microsoft announced that they were going to acquire them. We haven't heard much news since then, so it's been a really weird stock to own, but the stock jumped up to about $80 per share. So I'm up in the position, and I have not sold any yet because Microsoft's supposed to close the deal at $95 a share. Obviously, there's some risk. The fact that it's not trading anywhere near $95 per share implies that there's some risk that this goes down. Now, since I acquired my shares, I know Berkshire Hathaway and Buffett and that whole group jumped in and bought a whole bunch of shares, trying to play the risk arbitrage opportunity of closing the gap between $80 or 75, wherever it's at now, going up to 95. That's sort of why I'm sticking around in this one. So
So Activision Blizzard, great company. I think $63 is a great price to be in for Jimmy. When I looked at it, I think the intrinsic value of the company is around $90 to $95, which that's what Microsoft is going to be paying for Activision if it goes through, if it gets approved by the government. And he talked about Warren Buffett buying a big part into Activision. So originally, Warren Buffett, it wasn't him who bought into Activision. It was one of his lieutenants that did. But then he looked at the arbitrage and said, hey, if they're going to buy at $95 a share, if we were to have our average price be, $75, there's still a 20% uptick from there. Even at today's price, I think it's around $80 a share, something like that. I think somebody could argue that the intrinsic value of that company is higher than that, or even if it's on the low end, it should be around that price, right? So if it doesn't go through, it's still not a terrible price where it's at right now. And at $63, I think it's good either way. I think he's going to make money on the situation, unless all of a sudden the market really collapses and that stock collapses overall. But $63, I think, is a really, really good position to be in for Jimmy.
Liked Activision before the deal was announced. I'm happy to sit here and hold it and see if the deal gets closed. If it doesn't, I think big picture, I was happy with the price that I paid, $63.40. I'm more than happy with that price. So I'm happy to sit here and wait to see how it goes. Okay, next up, we have Meta. Last time I last time I updated this video, I had paid about $220 per share. This stock has continued to drop since then. As it dropped, I did average down to about $180, $183 per share. So I'm still slightly down in the stock. That's my average price, by the way. That is, all these updated prices are not, well, I bought it at $220 and then I paid $183. No, I bought it at $220 and then I paid less than that. I forget the new price. I bought it at $150 or something like that for Meta. My new weighted average price is the $183.90 for Meta. So when you see the new prices, they are adjusted prices. But the theory behind averaging down in so many companies, that I've done it in a lot of the companies so far.
All right, so Meta, $183 is where his price is right now for his average. Originally, it was $220. Meta is one of those companies very similar to Intel that is trying to change the footprint of the company, where Intel is trying to take on new revenue streams like Foundry division, for example. Meta is transitioning from Facebook, Instagram into the metaverse, and so there's a lot of risk with that, a lot of capital, a lot of R&D that's going to happen, and it's not a for sure guaranteed type thing. When I looked at Meta, originally, say a year ago, I felt the intrinsic value of the company was around, the 320 to $350 mark. Now the revenue has really dropped with the iOS privacy changes for Apple and other things that are going on that are headwinds for that company. I think the intrinsic value is probably more in the 220-ish type range right now. But even that, I think the stock is around $140. I mean, it looks really, really cheap. Out of all the FANG stocks, this one looks like it's probably the best value out of all of them, but also carries probably the most risk overall. It's one of those stocks that if you believe in Mark Zuckerberg, then it makes sense to buy into that company. If you don't believe in his vision, don't believe in him as a CEO and as a leader, it probably doesn't make sense to buy into the company. But to me, it's trading at an incredible price right now. That 183 that is average. It should do good long term. But obviously, the metaverse and other headwinds that they're encountering, we'll kind of see how that plays out. But I do like that position in his portfolio.
The theory of averaging down is every now and again, the stock market runs through these enormous hiccups, these pullbacks, these recessions. It happened in 2008. It happened in 1999. It happened in, I believe, 87. It happened before that. I think there was one in the early 90s as well. Point is, every now and again, the stock market's going up, and then there's a pullback, and then it continues higher. At some point, the United States, the world, is going to emerge from the troubles that they're in right now. And I truly believe that investors that can position themselves well in this particular environment are going to be very happy that they did 5 years from now, 10 years from now, when the stock market is hopefully much higher than it is today. Hence the reason that as the stock market has fallen, I've tried not to emotionally get rattled, although I acknowledge that can be difficult. But I try not to get rattled and try to say, okay, do I still fundamentally like the company? If I do, I'm more than happy to average down, fully expecting that, yeah, sure, their free cash flow might be dipping right now, but in 5 years, I expect it to be back up, or in 8 years, 10 years, whatever the number is, depending on the research, I expect it to recover. So if you're wondering why I added to so many different positions, it is because timing the market is nearly impossible. And I buy them and I'm thinking, that's a great buy. And then the stock keeps dropping. Now the stock market in general has kept dropping, but as it has, instead of adding, 10 new positions or 5 new positions, I've rolled a lot of that money into old positions to try to average down and get better cost bases for the stocks that I really like. Okay, up next is
So some great advice here from Jimmy. He is a long-term investor. He's looking at, 5 to 10 years out into the future. And he's not necessarily looking at and saying, okay, I need to time the market right. He said, you can't time it. And I agree with that. I am not a proponent for people to go and just pull everything out of the market right now, even though the market is down 25% year to date. At least that's what the S&P 500 is. And my personal viewpoint, take it for what it's worth, I do think the stock market is going to continue to drop throughout the year. I don't think this is the end of it. I could see it dropping another 10, 15, 20% or even higher because unemployment hasn't dropped yet. And I think that's kind of the third leg before it really sends the stock market down overall. But I do agree with him that this is the time, if you can position your portfolio whenever the economy does recover, and then the market tends to recover right after that, you can really see some really good gains several years out into the future. And that's what he's trying to do. So he's looking at all his stocks that he has. As long as the story is still correct, it makes sense to dollar cost average down into them overall.
It's actually one of my favorite companies, and that's Google. So Google's a big piece of my portfolio, and you can see that it right now represents about 16% of my portfolio. And last time I had done this video, I had actually paid almost $2,500 per share. Now, since then, they did a 20-for-1 spinoff. So adjusted, my actual cost after the spinoff would have been about $124 per share. Now, I have averaged this one down as well, and I brought my average cost down to about $118. Now, this is one of those that if I want to buy more, but I don't want the position to get too large relative to my other positions, which is why I've hesitated. I believe Google's in the $100 range right now. So again, I'm down in this position. I've got a handful of these outside of maybe Activision, Lockheed Martin, I'm up. There's a few of them that I'm up. I got a couple others that I'm up. But overall, the ones that I'm down, I'm trying to average down in, but I'm also trying to keep the portfolio from getting too heavily concentrated in one stock. Google, I've sort of gone a little bit nuts on it, but again, I think that Google 10 years from now is likely to be doing better than it is today. It's one of those companies that I'm more than happy to buy for value. Okay.
All right. Google, 16% of his portfolio. Interesting. So he's got Meta and Google that are together 25% of his portfolio overall. Google, I think, is an incredible company. I think it's over $1 trillion right now as far as market cap goes. Their moat is just absolutely impressive. Google's just one of those companies I personally believe, even at $100 a share right now, I don't think there's a lot of margin of safety with his average buy price of around 118. I think that's actually pretty close to what the intrinsic value of Google is in my personal point of view. But I still think it should do well long term. I think it should probably do just a little above what the average of the market will probably do over the next 5 to 10 years overall. But it's one of those companies where someone asked Warren Buffett at one of his Berkshire Hathaway annual meetings, and he said, what type of margin of safety do you need when you buy into stocks? And he said it depends. It really depends on how good they feel about forecasting numbers on particular companies. For example, like Apple, obviously he's able to forecast and strongly believes what that company is going to do going into the future, and is okay with today's stock price because he's been continue to add into that stock even though it's 40% of his portfolio. So Apple, he may only see a small margin of safety, like 5% or even no margin of safety, but he believes that it's easy to forecast those numbers going in the future. I think Google is one of those companies as well, but I don't think it has huge momentum going into the future. This is not a stock you would buy, in my personal opinion. You could 3x or 2x over the next 3 years or whatever it may be. I think it's going to be kind of a steady Eddie type thing over the next 5 to 10 years, but a fantastic company overall.
Okay. Next up, I added Warner Brothers Discovery. Now, I mentioned before that when I bought AT&T, AT&T spun off Warner Brothers Discovery. Because of that, I actually got 1% of my portfolio was Warner Brothers Discovery. That's, we got shares for owning AT&T. And my average cost at that time was about $24 per share for Warner Brothers. Had nothing to do with AT&T. Warner Brothers, the calculated average cost post spinoff was about $24 per share. Since then, I have averaged down my average cost to about $14 per share. I just recently did that in the past week or two because Warner Brothers Discovery has dropped a decent amount. Now, I did a video on them not long ago. Like I said, there's videos on all the companies I've bought. I won't buy a company unless I first make a video on it, so I can explain why I'm buying or what I'm thinking. But Warner Brothers is one of those companies that Warner Brothers Discovery is pushing together their platforms. They've got a lot of work ahead of them. So again, I recognize the risk involved in this company and owning this company. They have to achieve the goals that they've set out that they set out for themselves. I've invested in this company thinking they can achieve it. So I'm more than happy to sit here and hold this stock and see how it plays out over the next few years.
Okay, so Warner Brothers Discovery, this is an interesting one because when you have two large companies like Warner Media and Discovery merge, a lot of times the market just doesn't know how to value companies like this. They don't have those same type of metrics that have been around, say, for 5, 6, 7, 8 years, where they can compare and say, oh, the PE or, EV over EBIT or book value per share, that looks like a good valuation compared to what has been historically. They don't have that type of information. Then on top of that, you have, AT&T shareholders who own 71% of Warner Brothers Discovery after the merger. A lot of them didn't really care about owning this company. They cared more about owning the AT&T shares. They sold, and we've seen a large suppression in the stock price going from almost $30 a share down to around $14 a share today. Actually, it might be lower than that. It might be around $12. When I looked at Warner Brothers Discovery, I think it's in the $25 to $30 as far as intrinsic value of the company, thinking they can hit around $13 billion of EBITDA, which the management is saying they can do a couple of years out. But when you have two large companies like this trying to synergize them, try to harmonize these two companies, it can be very, very difficult. So we're kind of have to see long term how this is going to go. But I do like that position. Now, 8% is kind of high based on the type of risk I personally think that comes with Warner Brothers, but it should be interesting going forward.
Okay, next up we have Apple. This one I kind of got lucky with. So discounted cash flow is my favorite way to value stocks. It works very, very well for large companies, a company like Apple where cash flow is somewhat predictable. One of the keys to discounted cash flow is that you have to have a discount rate. You have to have, what is my required rate of return? If I want to return 5% and we think they're going to earn how much cash flow, what do I have to pay today? If I want to earn 10%, what do we have to pay today? My required rate of return was 7.5%. I picked that rate because it was a premium over AAA corporate bonds. As you may be aware, since then, since I was using that, interest rates have gone up a decent amount. So I increased my required rate of return from 7.5% up to 9%. Again, trying to offset that. Now I have a premium over AAA corporate bonds. If rates keep going up, I'm likely going to have to increase my required rate of return again. Well, as that was happening, I turn around, I'm analyzing, I'm using our discounted cash flow calculator, and Apple keeps popping up as a stock that looks like it is getting close to being undervalued. Then it drops down. I end up jumping in and buying my shares. It dropped below 141. That was where I was trying to get it to. Dropped below 141. I got a fair value, I believe, of 145 at the time. I jumped in and bought some, and I got an average price of 140.76, and the stock bounced after that, and I don't think it's back down there yet. I think the stock's up to 145, 146, 147, something like that. That one's held up quite well. But the reason why I say I got lucky is that like 2 weeks later, I increased my required rate of return from 7.5 to 9, and just like that, Apple was no longer undervalued. So I was a little, luck of timing, if you want to call it that. Okay, that being said.
So let's talk about Apple's average buy price is around $140. Interesting. So this is the third FANG stock that showed up: Meta, Google, and now Apple. So large companies that we're talking about. I mean, Apple's obviously over $1 trillion. Warner Brothers Discovery, that's I think around $50 billion. Google's massive. Meta's, what is the smallest one on this list? I don't know if there's any of them. Maybe Activision Blizzard's probably the smallest one, but most of these are well over $100 billion market cap overall. Apple, interesting. It's just one of those companies that I would love to own, but there's just never been a margin of safety there. Obviously, Warren Buffett and Jimmy like it, and they're buying it. But it's not one of those where I have been able to buy into just because that margin of safety isn't there. Obviously, they have a huge moat, but I just have a hard time believing that Apple is going to beat the market in the next 5 or 10 years. Just when you get that large and you don't have a lot of different revenue streams, where Google has a lot more, in my personal opinion, I just have a hard time believing Apple is going to beat it at the price that they're at right now. We'll have to see long term, but interesting.
The next company that I added was Citigroup. Now, Citigroup it's a small position. I made it a half-size position. Again, a link to the video I made on that company in the description below. But I had bought my shares previously at about $46 per share. Since then, the stock is a little bit below, I believe a little below 40, low 40, something like that. And I averaged down a bit to about $45 and change. Now, Citigroup, I bought again. This company has been fairly stagnant for the past few years. The management team has since then, in the past few months, even the past year, has laid out a plan for how they're going to leave some businesses, they're going to go into some new businesses and try to grow the company. And as I was reading through it and analyzing their numbers, if they pull it off, there could be some growth again. And again, this company looks like it could be a good deal at this price. Now, I did not use discounted cash flow for the bank because discounted cash flow doesn't work for banks. Banks don't have normal types of free cash flow. So there I used price to tangible book value. And that's actually going to be the second valuation method that we add to the website once we work out the kinks of the beta version of the website. So if you want to come over and sign up to our investing website.
All right. So Citigroup, this is a stock I like a lot. Personally, I own it as well. He already kind of alluded to it, but this company compared to its peers has not done well in the past. You look at Wells Fargo, you look at JP Morgan Chase, you look at Bank of America. Citigroup is the fourth largest bank in the entire world, but it has lagged those other three in the United States. And the reason why their management has not been as good, they have different segments of their business that are just not very profitable. And they have a new strategy in place where they're actually getting rid of 14 different segments of their business or closing different offices down around the globe. And that is going to improve their profitability. I think their revenue is going to be fairly flat over the next few years because they're closing those different branches, but their profitability should increase. If you look at the return on tangible common equity, historically it's been well under 10%, where their peers have been in the 11 to 13% range. But Citigroup, we're starting to see that improve even over the last quarter or two, and that should continue to improve. But it is a transition that's going to take about 18 months to 2 years to go through. But if they can pull it off, the stock price should be around $80 a share, which is be about double from where it is right now. And they pay a 4% dividend, which is pretty incredible overall. So those are the stocks in his portfolio. Again, these are very, very large companies. There's no small companies that are here. But overall, I think this is a portfolio that should do fairly well going into a recession, which I think we're in a start of right now. A lot of these companies pay dividends. If you look at, I would compare it. If you probably compare his portfolio to a lot of other portfolios that are out there, it probably is not going to have huge gains, but it's not going to have huge losses either. I think it should do okay. I think most of the stocks that he has here, they're very easy to analyze. They're very easy to forecast and come up with intrinsic values, but some of them I just don't see that they have a lot of margin of safety, whether it's from Apple or Google, for example, even AT&T. Intel, his cost basis there, but it'll be interesting to see overall in the long term how it does. So I'd be curious from you guys. What do you think of his portfolio overall? Do you like it? Do you own any of these stocks here? Are there any stocks on this list that you would say no way I would not want to own at all? I'd love to hear from you in the comment section. Thank you so much for watching. I'll catch you on the other side. Take care and God bless.